Welcome to Fintech Chatter News, presented by Tier 1 People, leaders in Fintech executive search. Follow us on your favorite podcast player or Fintech Chatter TV on YouTube.
Well, welcome back to Fintech Chatter News. I'm your host, Dexter Cousins.
Carolyn Breeze.
That's right, I'm joined by Carolyn Breeze. Before we chat to Carolyn, what else could we be talking about except the massive news over the weekend of SVB? And I'll have Scott Hayes of Mendoza Ventures a little later in the show to share his view from ringside in the US. But Carolyn, great to see you. Thanks for coming and joining me today on Fintech News.
Thanks for having me.
Tell us a little bit about Scalare Ventures.
Yeah. Scalare Partners is a VC firm or an investment firm focused on tech companies that are very early stage. So if you think about the market more broadly for investment, there's a lot of startup bootcamp type scenarios, and then you've got your typical VCs that are writing, $1, $2, $5, $10 million checks. And there's a real gap in that seed funding rate, like rounds for those smaller startups who are still scaling, and that's the problem that Scalare solves. So they usually write the first or second check in a seed round. But the model is that they partner really closely with the tech company and organisation and give them access to all of the benefits of the Scalare community and the scaling programs to help them grow, and they stick with them and see them through.
Now, a lot for us to talk about today, but to give some context, FinTech Leader of the Year, eBay, Braintree, Go Cordless, Zepto. I mean, you've worked with some of the biggest FinTech in the world. A kind of authority on payments, which we're going to talk a lot about today. But before we do that, look, the other side to it is kind of SVB. And whilst it's in the US, certainly, we're hearing of impacts here for Aussie Fintechs. What's kind of your take on what's happened over the weekend, Carolyn?
Yeah, it's interesting. It's that old saying, when the US gets a cold, Australia has a sneeze.
Yeah.
And there are a lot of ambitious fintechs. We're very proud of those that have grown to international markets, and the US is a flagship one of those. So it's inevitable that a bank that supports early stage tech startups, and particularly fintech, if something was to happen there, that it would have a bit of a ripple effect over here. And I know that there are some Australian fintechs that have been affected. I think one of the things that made Silicon Valley Bank a great partner for fintech startups is that they removed a lot of the barriers to entry. So if you were looking to get boots on the ground and scale over time, you could use a bank like Silicon Valley Bank to access their licenses and use another partner and not have to go and get your own and, have that support to scale. And that meant that they had a very early stage base of clients. And unfortunately, they're the ones that can't afford a hit like this.
Yeah.
So it's really unfortunate. But it's also it reminded me a little bit of the recent crypto scenario, in that it was also almost self-prophecy. Once people got wind that there was an issue, they went in and started withdrawing their funds, and then ultimately, that's the outcome. So I feel for the Australian fintechs that have some funds in there. I'm hoping that it wasn't, more than 250K, whatever that threshold is. But I know that the Australian community would be getting behind them and the founders themselves. And I think off the back of the year or two we've had, particularly in the funding market, so again, they're the same fintechs that would have been involved in SVB. I think it's just important for us as a community also to think about the founders' mental health and wellness.
Absolutely.
And make that the priority.
Yeah, I'm sure that all the armchair critics will be out kind of dissecting what's happened, and it's just it's not needed right now.
No,
right?
I even saw a couple of posts over the weekend on LinkedIn of people saying almost like I told you so, who I've never heard mention Silicon Valley Bank before. Like all of a sudden you knew what was going to happen. Yeah, I doubt you did.
Yeah. Look, it is a shame, right? Because it seemed like a very solvable problem on Wednesday last week.
Yeah.
And it's and that's, I guess, another thing that's really kind of, I think it's highlighted a massive issue of the how quickly technology has evolved. Is one, I think it's the first bank run we've ever seen fueled by Twitter. Yeah. And two, I think, and it's something that I think people need to understand about the Australian banking market, right? Is that there are caps on what you can take out and daily limits, right? Yeah. Whereas in the US, that just people are just withdrawing everything, right?
Exactly. And one thing I think that there might be a knock-on effect of is, unlike the Australian market, in the US, it's very transparent when you're working with merchants who your acquiring or sponsor bank partner is.
Yeah.
They make that really transparent, whereas here it's not really talked about unless they really need to know, because it's all front-ended. And over there in that market, I remember when we were at Go Cardless and we were launching into the market, enterprise was a big focus for us. Those enterprise entities want to make sure that the bank supporting the fintech is of enterprise quality, somewhere where they would bank themselves. And it's a shame because now what's happened with Silicon Valley Bank, I think will have a bit of an echo throughout the market.
Yeah.
They'll be even more cautious of acquiring and sponsor bank partners, which I think will make the entry even harder for fintechs.
Yeah. Now, as I was putting together the kind of run through of the show last week, I think I sent you the first draft on Thursday last week, and I've made another 4 drafts since then because it's just been news after news after news, and it's not been a little PR piece. It's been really significant stuff.
Yeah.
So I want to kind of shift the conversation onto something really positive, which was something announced on Friday, and that was Basiq being acquired by Cuscal.
Good news.
Yeah.
I really love the Basiq team and Demir, and they actually did a partnership with Zepto around a payments piece, and I got to know the business quite well.
Yeah.
We used to work very well together, and it couldn't have happened to a nicer bunch of people. And it makes a lot of sense for Cuscal as well. It gives them entry into that part of the market that is a little bit smaller than they would normally bite into.
Yeah.
It gives them access to that data and categorization of data and how they use that to make decisions, and give that access to all of the other merchants and clients that are using them. But something that really resonated for me in the model is that Demir has always said, that Basiq is data-driven payments.
Yeah.
So the data is actually driving the payment initiation and the conversion of the payment, in the context of the everyday activity of the end consumer. And I love that when you think about where we'll be in 2 to 3 years' time, where we'll be making micro buying decisions in context. Those data-driven decision-making tools are there, and open data and open banking is key. And so it's a perfect marriage because Cuscal have all of the payment acquiring technology, but they don't have that data-driven piece. And so it's just, it's really, really clever. And I can't congratulate Demir enough. I sent him a text when I saw it in the news. It's just fantastic.
And I hope the price that he got is enough to pass on to his 6 kids as well.
Yeah. At least have a holiday, Demir. His man has not stopped working for years.
And also, look, on the flip side, I've got Bianca Bates from Cuscal coming on the show in a couple of weeks.
Excellent.
And really great operator. And I think what really struck me when I first started working with Cuscal a few years back was just, I'd always thought of them as this outsourced provider to credit unions. And the kind of history of innovation within that business is, it's quite startling actually when you kind of look beneath the hood.
They were the first to do a lot of things, and they don't, you don't hear about that as much until you talk to, Bianca or Nathan or Kieran or someone, and they talk you through some of the first to markets they delivered, and it's pretty out there. And they enable so much of the market.
Yeah.
And it's interesting because they were very clever a few years ago when the big banks started to unbank a lot of the acquirers and processors and payfacs, and Cuscal had quite the right, I think, risk appetite at that moment to capitalize on the market. And then they've used that momentum to build, what is there today. And I just, it was fantastic.
In light of what happened at the weekend as well, kind of, hopefully this is a kind of a launch pad for fintech startups to get ideas off the ground with a setup that's a little bit more kind of founder friendly as well. Yeah,
100%. And I think Basiq have done a really good job. Jara and the team of setting up the startup and kind of tech startup bootcampy stuff within Basiq and giving access to the tools in the sandbox and allowing people to jump in and create these use cases. And again, that's a perfect playing field for Cuscal to get more involved in that part of the market. So, it's perfect.
Now, sticking with the payments theme, we also, there was another massive announcement, 70 million.
That's a huge raise.
In this environment.
Yeah.
From Till Payments.
Yeah.
What did you make of that?
Yeah. Look, first of all, congratulations, obviously, to the guys. That is an epic raise. There's been some really great raise stories and success stories since coming into the new year. So despite the market obviously people are still investing.
Yeah.
And they're just looking at investing in those businesses in a different way. So it's not about the growth anymore. That's one part of it, but probably third, it's more around the actual revenue and the run rate and the go-to-market piece. And I know there's been, I have seen a lot of commentary on LinkedIn and from the market around Till's valuation and the changes they made to the business prior to going into the raise. And, the amount that was raised and the dilution and those kinds of things. And at the end of the day, what we need to remember is they kept the business alive.
Yeah.
And sometimes you have to make those tough decisions. They did wait till after Christmas as well. They did, I think they did things in a really thoughtful way and caring way. But at the end of the day, they needed to show the investment market that the business comes first.
Yeah.
They need to keep that business alive, that it does have potential, that the work has been put in. And to do that, they had to make changes.
Yeah.
And they also had to, raise more against that value, a lower value than they probably wanted to or would have done 18 months ago. But all of that being said, the message we need to take from it is there is still money in the market for the right business, and founders are willing to make the changes to have their businesses survive. And that's exactly what Till have done.
Yeah. And look, it's kind of one of those tough things, right? I remember would have been 3 years ago, and I think Shadi was the guest on before you, right?
Yeah.
Which I think it was like episode 15 or something like that. And at the time there were 30 people. And then Shadi came on the show again a year and a half later, and there were 300 people. And it's just incredible, right?
Yeah.
The growth. And I think, unfortunately, that was maybe it's the end of 2021.
Yes.
The headwinds that have faced, the whole sector since then. I mean, you look at buy now, pay later, and how some of those businesses are still going. It just absolutely amazes me, in the resilience and kind of ingenuity and problem solving that these founders must be doing on an almost like second basis. Is just incredible. And
I know it sounds difficult to do, but when the business went from 30 to 300, we would have celebrated that, celebrated the growth, thought, wow, they're doing really well. I wonder what they're going to do next. 300 staff, watch this space. We almost need to be as supportive as an industry and empathetic when the opposite happens.
Yeah.
Like when they do lose people, instead of regurgitating the article on LinkedIn and like, XYZ people cut from Till, like it's a hard time.
Yeah.
No one does that and enjoys it. That's a tough thing to go through. And I think we need to give the same level of support and go, it's tough over there. Obviously, they've got significant plans and opportunities they need to stick to, and they need to lean down their business in order to survive. And we need to give them that support. Yeah.
Now, there was another big bit of news last week, and I'm not one to kind of talk about redundancies, but I felt I had to with this, and that was the Xero shedding 800 jobs. And in the same week, not connected with fintech, but still really significant. Atlassian announcing 500 job cuts. Atlassian had been so vocal about actually hiring people. And I think what this shows and, just showed to me was like, this is kind of serious now.
Yeah.
I think what we'd seen up to that point was mainly kind of startups who, you could have questioned a lot of them, hey, well, were they going to be around anyway?
Yeah.
And now what we're seeing is significant businesses. Xero, the biggest tech business to come out of New Zealand.
Yeah.
Atlassian, the biggest tech business to come out of Oz, having to make significant job cuts, right? And I think, the harsh reality is that the economic times that we're in, these are just the decisions that have to be made. And as much as it's painful, it has to happen.
Yeah, it affects businesses of all shapes and sizes. And I think when you see those big numbers in the press, 800 from Xero and 500 from Atlassian, they're big numbers, but in context, they're global headcount.
Yeah.
It's the same as a local fintech shedding 25% or 15% or 10%. And so we need to kind of keep that in context. And the other thing is, for a lot of those big companies, just like small ones, they need to be agile and pivot and be seen to be doing the right things in order to maintain value and grow and potentially, share price as well with investment. And so they need to they're not immune to it. They need to make the same decisions. And both had gone through significant growth and headcount growth in the last couple of years. And so it could be more of a resetting as to back to where they were. It could be also tied to certain strategy or changes within their that what they're actually doing as a business. It's easy for us to attach it to the macro market and take it as a worry, but in the context and the scheme of it, I don't think.
Yeah. And look, I was actually on Biz TV and I said exactly the same thing. And if you look at you unpack, the Xero and the Atlassian announcements, these are part of strategic reviews. And the reality is, and this happened, 2008, 2009, 2010, every business was forced to look at, what's our core business? What do we do really well? And if you look at the last few years, there's been a lot of kind of divestment. There's been a lot of, let's go and dip our toe into, and innovate. And unfortunately, some of those bets aren't going to come off. I think what was really interesting was, kind of footnote on the Xero announcement was an investment that they'd made or acquisition of Waddle.
Oh, that's right.
Yeah. And they've decided to kind of take a loss on that. And so I think this is just the reality, right, of the environment that we're in, is that some of those bets now are kind of, they've not paid off, and you just have to cut the cord, right, and move on.
Just got to cut the fat. Yeah, I saw that this week, and it honestly feels like yesterday that we were at Intersect in Melbourne. It was 2 years ago. I had to really work it out when Waddle were being just feels like it just happened.
Yeah.
It's a shame, but they're the decisions that they have to make, and if they were letting headcount go and not making those decisions, you'd question that as well. So it is what it is.
Yeah.
I don't think that actually we should take anything by that as regards to like other acquisitions and mergers and things happening in the market. It's just a decision that they had to make in time that we're in.
Now, we've talked about there still being money around, and it seems to be, and I certainly don't want to kind of claim it to be some sort of oracle, but it was really clear at Intersect last year that there were these kind of three areas where there seemed to be big opportunities still to be found. One of them was, I guess, not just business banking, but that whole kind of accounting tax side. We've seen Henry raise 35 million this year. Another of them is the merger or the kind of convergence between payments and blockchain. And we talked about Till, but also Datamesh. This year announced just a couple of weeks back, I think a 35 mil raise. We then, I guess, had the announcement from the RBA of the pilots around CBDC, and we're going to have a really cool kind of podcast coming up this week as well that I recorded just recently with one of those pilot schemes. And I'm really excited about it. And I think the reason why is that of all the use cases, they're all things that I was thinking, over the last 10 years, why is the government not kind of, GST, like it's just a perfect use case for program GST into transactions. Yeah. So what's your thoughts on I guess, first of all, the data mesh raise, and then kind of, this convergence between payments and blockchain?
Datamesh is super exciting. Mark's done a brilliant job. And it's interesting because they're one of those organizations that you don't hear much about.
Yeah.
And unless you're in our industry, you probably haven't heard of them at all. They're not a consumer-facing brand. They're like a layer of payment technology. But they're not in the press a lot. They're not on stage a lot. And so, they've grown a very scalable, deliberate business. And their expansion internationally has been very purposeful. And I think, and the raise is apt for where they're at and their value. So that's a really exciting business. But I love that they're kind of, no one's really heard much about them unless you're thick in the weeds. That's what I like about that one. And then moving on, tying into the CBDC pilot, very close to my heart. So in my last few months at Zepto, I had the opportunity to represent Zepto at a few of the round tables that Steve Vallis and the team had set up with the RBA, and to meet all the other parties that were interested in putting use case forward. And I think even having the pilot and opening it up to the market like that, it's such a huge opportunity. Yeah. And I had a look at the list of the people that were accepted, or the companies accepted in the use cases last week, and it just filled me with pride. There were so many familiar names on that list, and I'm so excited. And the other thing I love about it is it'd be very easy to tie it just to payments or financial, institutions and use cases. But there's a couple in there that are kind of bordering in other verticals. So, for for example, the guys at Not Centralized have put one in for the construction industry, where they're going to use blockchain almost like a smart contract type scenario, where the money is secure and it's paid out to the different vendors in that contract at certain milestones being met. It's easier for the banks to lend against. It's easier for people to know when their money is coming. There's no qualms about it or uncertainty at all. And I think that's a fantastic use case to tie back to something stable.
Yeah.
And I think it's about time. And I saw something the other day on LinkedIn. I think it was Richard mentioned something around 3 to 5 years. And I said, I think that's like almost 2 to 4 years too long.
Yeah.
I'd love to see us getting out sooner than that, because Caroline Bowler made a really good point at the last roundtable that Steve pulled together, where she said, if we launch too late, we risk ending up in this situation of soft power like we have now with the US, where the dollar dominates. And we've already got people very close to home like China that have launched their own stable coin and other markets. If we leave it too long, we're always just going to be the rounding error. Like, we need to get moving. I think we all agree it needs to happen. I think the use cases are going to help prop that up, but I don't know if we've got 3 to 5 years.
Yeah.
And I think the other point is ZeroCap have done a great job of setting one up already. And if we wait, there'll be fantastic companies out there like that setting up stable coins that will start to dominate. And then if we do try and release our own stable coin, we're almost competing asset-wise amongst ourselves. Like, there's only so much in Australia that we can stabilise it against. So I think we need to get really unified.
Yeah. I mean, if you look at the issues just that we've had with superannuation, right, over the last decade, and struggling to find assets, right, to put the money into.
Yeah.
So
I think that's something people don't think about, is that it's got to tie to an asset.
Yeah.
And so, already we'd be not competing, but that kind of soft power piece with the US and China. Like, we can't leave it much longer. We need to get moving. But I love some of the use cases that have been put forward, and I'm looking forward to seeing it through. I'm trying to get involved wherever I can to try and give people a hand, just so I can stay close to it, because I love it so much. So
now we're going to take a quick break, but when we come back, we're going to talk a bit more about Scalari Partners. Shameless plug time. Quick shout out to our friends at PlanPay. Each month, I'm giving a shout out to a startup I think is doing something a bit different. PlanPay unlocks a world of travel experiences by splitting future bookings into flexible installments, using your own money rather than credit. They recently announced big news and a partnership with hotel chain Ovolo and booking engine Roomstay. It's perfect for families like mine trying to manage their budgets, or small business owners like me dealing with the increased costs of business travel. Whilst Ovolo is the founding hotel partner to offer PlanPay, the aim is to bring more travel providers onto the platform and endless options for payments. Why I think PlanPay is one to watch out for is they're a different proposition to buy now, pay later, because there's no pay later. It's all upfront payments and no credit facility. It's the customer's own money all the way, just divided into upfront payments rather than using a credit facility to fund the purchase and then having to pay it back. PlanPay don't charge late fees, interest, or penalties whatsoever, because there is no credit risk to them or the customer. The revenue comes solely from merchant partners rather than individual customers, and their merchant fees are some of the most competitive in the market. To check them out, go to planpay.com. Right, now I'm heading off to the US, and we're having a bit of a chat with Scott Hayes from Mendoza Ventures. He's our man ringside seat this weekend for what's been happening at Silicon Valley Bank. Well, Scott, welcome. What a weird week.
Thanks, Dexter. Happy to be here. And, most definitely a weird week. It changed pretty quickly, probably about lunchtime on Thursday for me.
Yeah. You've had a ringside seat to events this last week.
Absolutely. So it was actually quite unique. We're really busy at the moment. We're fundraising for a couple of funds. We're helping founders. We're leaning in. Times are a bit tough. But also, I've got CFO duties. It's in the middle of tax season and getting tax accounts out to all our investors and stuff like that. So 2:00 on Thursday, I got this unusual email from Silicon Valley Bank saying that the CEO would like to speak to all the VC clients. And I thought that's quite strange because you don't normally get these emails. So straight away I Googled Silicon Valley Bank and saw the share price was down 55% at lunchtime. So I go, okay, something bad's going down here. And then they mentioned like there was an 8K report and saying they're going to do an emergency equity raise of 2.5 billion. And, I was a banker for 25 years, and my experience is stuff like this, when it's dropped on the market like that, it's never good.
Yeah.
So, I dialed in onto the CEO call. No questions were allowed to be asked. We've spoken for 10 minutes. The CEO just told us, and my experience as a banker straight away, it just screamed to me that this was just badly mismanaged from the start. He actually blamed the Fed increased interest rates, and that's what caused the problem. And straight away you go, well, you're the 16th biggest bank in America. You advise every tech and VC founder in America and globally. You're quite sophisticated, and you're blaming that we didn't know that interest rates were going to go up. And these were the most telegraphed interest rate rises I've ever seen in my career. So straight away it's just like, okay. And he didn't own the issue, like saying, well, hang on, we try to get 20 basis points better return so I can meet my numbers every 90 days and get my bonus. That's the real underlying reason why I bet the bank on something like this. And straight away after that, I just said to Adrian Mendoza, my GP, is like, we just got to let our companies know that they should take action and look to move their cash out.
Yeah.
And it was just funny, like, Friday morning at 9 a.m., we were told that the FDIC had stepped in. They now had control of Silicon Valley Bank, and the day before, $42 billion was transferred out of the bank. So it was the old classic run, but it's also the confidence thing, and it's just how it is.
Yeah,
very unique.
Yeah. So I've seen a few people kind of make reference that this was probably the first bank run in the Twitter age, and the irony being that the advancements in tech made it possible for the amount of deposits to be taken out as quickly as they were. What's your take on that?
Absolutely right, because I didn't even know anything was going on. I was just immersed in my work, and by 2:35, I'm telling our companies that they need to take action and get the money out of the banks, straight away. And then you look on all the social media, especially Twitter. Twitter's the VC favorite.
Yeah.
It's actually quite funny. It's mainly VCs just telling everyone what to do.
Yeah.
But I was all over that you need to take action. But the funny thing is too, look, I'm a custodian of our investors' money. We got 3 funds and 10 SPVs. And as a fiduciary duty, you have to do the right by your clients. So this is why people were decisive and took action. There's plenty who didn't, but that's just what it was. It was just at lightning speed this happened.
Yeah, it seemed like it was a solvable problem on Wednesday, and very quickly escalated. What's your take as to what could have perhaps been done a bit better to, avoid this kind of almost catastrophic event?
I think the messaging was extremely bad. And there was one line there when the CEO just said, "We are fine, we're all good, unless everyone takes their money out." And that was like the death knell for him to actually say that. But also, look, I think it was the day that the crypto bank went into insolvency too. So, it was a double whammy. And we've all got to remember too, for the last 10 to 12 years, everything's been priced to perfection. Every asset's gone up because of zero interest rates. That is now reversing, and any hint of bad news, the hedge funds just take over, and that's it. You get obliterated, and that's pretty much what happened.
We've seen some pretty appalling behaviour, I have to say, by some prominent VC types, scaremongering, and almost like you have to assume they're trying to short the banking market in the US. What's your take on that?
Yeah, look, unfortunately, VC in general as an industry, it doesn't have a great reputation. There are people out there who are quite predatory, and it is disappointing, but that's how some people operate. But you also got to remember too, you're in the lens of America where the dollar rules, and it doesn't matter how you gain that dollar. You can be a really bad actor, and no one cares. You celebrate because you've earned all these billions, and that's a self-fulfilling prophecy over here. So it's definitely un-Australian.
Yeah,
but in America, no one cares. It's all about the dollar.
Yeah, I kind of made the point a little bit tongue-in-cheek, and maybe it's not the time for humor, but it seems like Silicon Valley has finally disrupted banking, not the way they intended.
Yeah, absolutely. It's it was just funny though how this blew up, and I've been a financial institutions banker. This could have been completely avoided.
Yeah,
a bank of that size and magnitude that didn't have treasury is a basic function in banking, and banking's trust, and it's all about mitigating risk. How they could bet the bank on long-dated bonds and not hedge their position to match the liabilities position is an absolute joke.
Yeah.
And any treasurer in the world, would be gobsmacked to see a bank of this size just run their book like that and then complain when the Fed lifts rates saying they didn't know.
Yeah.
It's completely mismanagement in my book. I actually feel sorry for a lot of the staff. The people in the ecosystem are fantastic.
Mm-hmm.
They do own the ecosystem. And I've been in a bank where something like this has happened. The bank didn't have a run, but you go to work every day, you do the best by your clients, you take pride in the brand, and then something happens above out of your control. It's absolutely devastating.
Yeah.
So, there's a lot of good people at Silicon Valley Bank who are good supporters and of the ecosystem, and it's shattering for them. They were blindsided.
Now, you and I have kind of swapped kind of war stories about 2008 and kind of the events that happened then. We've seen there's been a little bit of kind of scaremongering here in Oz, and there's going to be a banking collapse. What's your take on the health of the Aussie banking system, and do you think there's the likelihood of anything similar to happen here?
I think Australia is one of the most soundest ecosystems in the world, especially for banking. APRA is all across this, and I'll give an example. In 2008, when the world blew up, then I was a natural resource banker in the middle of a massive deal that fell over, but none of the banks got taken down. And then 12 months later, I moved into property, but the property portfolio I had, the directive from APRA to the bank I was at was, you're overweight this position, you need to shed, and you need to bring back into alliance for diversification. And so something like this, a concentrated risk in one or two industries like Silicon Valley Bank would never happen.
Yeah.
So I think stuff like this, Australia has learnt they learnt from, the HIH insurance stuff when APRA came on board then. It's very, very minimal chance that something like this would happen in Australia, especially from the big four banks.
Yeah. Now we are hearing kind of stories and kind of reports coming in that there are some Aussie tech businesses who are impacted by this, and I think it might be 15 to 20 that I'm hearing. What's the status on the ground right now, and kind of has there been any developments over the last 24 hours as to what potential outcomes or what's going to happen to people's money?
Yeah, there has, Dexter. It's just been announced recently that the Fed is going to backstop all the deposits from Silicon Valley Bank. So everyone tomorrow should have 100% access to their funds. Us as a firm, we have very minimal exposure, not the firm directly, just through one SPV, and it's a minimal amount. I expect to be able to have access to those funds tomorrow.
Yeah.
So for the Australian companies, that I believe that'll be the same.
Yeah.
Yeah. And, and that just shows you too, that they actually had a very good program where they helped Australian founders come to America, open up bank facilities, very proactive. I know that team, and that team were awesome. They have got the best interests of the clients at heart. And for them, they've actually been blindsided by this too. And they've been left in the lurch too. So, it's just hard, something like that all around. Australian companies, what do we do? It's a relationship game. And this is even more example that if you come to America and it's a market you need to be in, you need to have boots on the ground.
Yeah.
You need to develop good relationships. They need to be broad. With my old banking hat on, you need to have multiple banks. And that's just a risk diversification. I've seen this play out before. Unfortunately, this movie, it's not a new movie.
It's not.
It seems to every 10 years to be replayed. But it's all about developing good relationships with a number of people and putting the work in.
And I guess, look, if you maybe can tell us a little bit about Mendoza as well, and potentially how you help Aussie tech firms launch in the US.
Yeah, absolutely. So Mendoza Ventures, we're a fintech AI cybersecurity firm. We're currently, we had our first close of Fund 3, which is a $100 million Series A to B fund. And, we've had 2 investments made that already. And we are after good quality companies. So if Australian companies are looking to come to America and they're in that range, the only caveat is most of our investors, well, not most, but a lot of them are banks and US banks. And so the Australian entities will have to be Delaware C Corp.
Yeah.
So you virtually have to have your head office in America. You have to do the flip. We're governed by that. So that's another example too, that you can't sort of run a global empire from Sydney. So,
yeah,
you have to be over here on the ground, and this is your growth market.
And what types of, are there any kind of areas within fintech and AI that you're particularly interested in? If there's Aussie companies out there that should reach out.
Yeah, absolutely. So in fintech, the stuff we do not do is crypto and prop tech. And the crypto side, we're thankful we've never really looked at that, but we do like blockchain. So we like infrastructure. We like, payment rails. We like anything that helps businesses, especially banks, insurance companies, big corporates, save $1, make $1, and bring efficiencies to the workplace. AI is great because it can cross over to anything. So, underlying fintechs or anything, you can have an AI component. So it's a good catch-all for those sort of industries.
Yeah. I know you kind of touched on crypto there. It feels like this kind of this SVB kind of outcome has played right into the hands of US regulators and the SEC and the kind of pushes that they've been making recently. And it almost feels like it's a massive self-inflicted wound by the whole tech ecosystem in the US. It's kind of just, it's almost like a classic kind of rope-a-dope outcome.
Yeah.
What's your sense as to kind of what some of the ramifications of this might be now that you've got the FDIC coming in and regulators coming in to rescue the day?
Yeah, look, you're right. It's actually a negative. Like we saw this with the FTX collapse. And, just the general view they like on crypto now and blockchain. Blockchain companies are finding it harder if they want to go in the regulation path to actually fit the right box and now get, the tick off from the regulator, the SEC. This here. And the funny thing is like this affects everyone in tech and this amazing ecosystem, but it actually doesn't affect Main Street. Main Street has no sympathy whatsoever has happened to Silicon Valley Bank, and they do not want to bail out the rich guys from Silicon Valley at all.
Yeah.
That's the general consensus of the average American.
Yeah.
So, so the SEC and government agencies, they're not here to really help the industry now. They'll probably be harder. And, you'll just have to play by the rules that they put out there.
And as the reality is that it's actually not bailing out the rich guys. There's a lot of small business owners and founders who put everything on the line and have everything, at stake right now. Which, that's, I think, the message that we kind of have to be getting out there. This isn't, kind of some, just few VC who are creaming off the top. This is actually, mum and dads and, people with families just trying to get by.
Oh, absolutely, Dixon. This is the devastating part, right? Friday morning, there's a number of stories of people whose payroll just couldn't go through. They had cash in the bank, but couldn't do it. They've recut their balance sheet and cash flows for the times and the market and got runway, and the funds have taken away. And the knock-on effect that is, and even just for the ecosystems around that, for the wider economy, it's devastating. You feel for these people, and especially founders, right? Because they normally put everything on the line to have a crack and have a go and trying to make this a success. And, it is tough funding environment, right? So everyone's bootstrapping and doing the best they can to get to a path to profitability.
Yeah. So if there's a silver lining from all of this, Scott, what do you think it might be?
I think, it's this, you just can't get past the diversification bit, the sound business management practices that everyone should employ. You just need to have wide relationships. You've got to be careful who you partner with too. I hopefully that there'll be firms, and we like to put ourselves in this bucket that you can partner with that actually lean in and help.
Yeah.
As opposed to, take off the top and, and this, unfortunately, there's been a few who've headed straight for the exits and, haven't helped, whereas others have leaned in. So, like anything, you just got to be present and just put the time in and just develop relationships.
Yeah, mate, there's a saying that I have for times like this where stars shine in the dark. And I think this is one of those times where we'll see who the real stars are. And as you say, those who kind of run for the hills at the sign of trouble.
Absolutely, Dexter. And I think I'm in for a busy couple of weeks, and we are as a firm, but we're totally here for our founders. And, we've got a good network and a good ecosystem, and that's the important part. And everyone's pulling together to get through this and then take a big breath, and then we'll just push on.
Awesome. Well, Scott, look, it's been great to catch up with you. Thanks for calling in. Next time I think we'll have something hopefully a little bit more kind of positive to talk about. And take care, my friend.
Thanks, Dexter. Thanks for having me. It's always a pleasure to catch up and have a chat. Appreciate it.
Well, welcome back, Carolyn. Great to see you join my good friend James at Scalari Partners.
I didn't know you knew James.
Of course I know James. Yeah, James, I've known him for about 5 or 6 years. I know you're a really great human being.
Yes.
But first of all, congratulations. I was really chuffed to see you there. Can you tell us, I know you did a little bit of an intro at the beginning of the show, but can you tell us a bit more about what you do, some of the ventures that you're involved in, and kind of what makes you different? Because I've had so many chats with James over the years about, VC and what can be done better, and, kind of what Australia needs and the nuances of Australia and what might work here and what might not.
Yeah. Oh, well, I'm very fortunate to have landed there. The guys are fantastic. So Nick, Giles and James are the founding partners, and I've had the pleasure of knowing them for about 9 months. So I jumped in to help support some of the startups if they needed that kind of scaling and commercialization mentorship, and got to know the business pretty well. So I was pretty chuffed when they asked if I would come on to the business. But they're relatively young, so they're only about 4 years old. And currently there are 22 and a handful being announced soon of startups within the portfolio, and predominantly tech. So they're a tech advisory and investment firm.
Yeah.
But they go in very early. So they're usually seed round. They usually write the first or second check, and they work very closely with those organisations to help them scale and grow. They've got a great community of non-executive directors. They've got advisors. They've got scaling programs. We do masterclasses. We do sprint runs with the startups to help them grow, and we stick with them right throughout their journey, which is fantastic. And I think what the guys identified very early on is there's a lot of firms out there that are very focused on the very early kind of pre-revenue MVP almost type stages. So think of your StartMate boot camps and things like that. And then you've got your traditional VCs like your Airtrees who come in at a Series A or sometimes a B and can write much bigger checks. And there was this real gap in the middle when you're trying to raise between 250 and 500K for that seed round to really get moving, and you've got a very lean team, so you need access to almost like a virtual CFO or a virtual marketing team or a virtual technology team, and you really need that advice. That's where we come in and benefit. So we've got all of those services there, so that you can leverage us instead of having to invest in that. And then we sit with you all the way, and we have an executive director on the board to help you with the governance piece, and we help stick with you and scale you through.
Yeah. I think what's really kind of worth noting as well, I'm good mates with Ryan at Cape, and kind of, have seen kind of, through the friendships with him and with James, just how well that whole dynamic works. And, if I look at Frankie One as another great example, I think the distinction I would make is that the people that you're investing in are proven, like,
Yes.
super. They've been there, seen
They're
it, done it.
superhumans. Yeah. No, they really are. We have we've got Kate, we've got Frankie One, Master Remit, Stadio. There's a bunch in kind of fintech and Web3 that would be really familiar to this audience. And then there's a lot of kind of tech and edutech and agri-tech and things outside of that. But, we look for companies that are generating revenue, that are getting traction and ready to scale, that are living their life's work. It's not their side hustle, but, they're wanting the help, they need the help, and they understand what we can deliver. And then the main ingredient is those founders and how amazing they are. And Ryan's a perfect example of that.
Yeah. Now, we've talked a lot about fundraising today, and so obviously the dynamic shifted, the market shifted. What was really interesting was when you talked about Datamesh. I actually interviewed Mark for the podcast, and maybe it was about 3 or 4 months ago. And we were just asking about, I asked him the question about fundraising in this environment. He gave a really fantastic answer, which I kind of cut out and edited and put as like a 5-minute little short, right? But what was really kind of great was to see that, 3 months later, he's obviously taken his own advice and announced a raise at a time where very few have been able to do that. What tips have you got for founders out there who do need to go and raise in this type of environment?
Yeah, I think, Chris from Zepto used to say this, and it rings true across everything that I'm reviewing at the moment, which is the 1% of the 1%.
Yeah.
And I think people have to be really realistic about their valuations. I still find that's a bit of a hurdle. I think there are founders out there who are still maybe expecting too high multipliers for what they're delivering. This hasn't changed because of the macro environment. This was always the Scalare approach, but it needs to be a sophisticated and level multiplier of the actual revenue that is happening. It's not, a 10, 15, 25, sometimes 35x multiplier on your revenue. You need to be realistic about where you're at.
Yeah.
And if you're looking for really high money and you don't have a clear path to the return or how to spend that, and that would be over time, then that rings an alarm bell as well. So, if you're a company generating 150K annual rolling revenue, valued yourself at 15 mil and you want 3 mil, that's not good maths.
Yeah.
And so, it's understanding where you sit, what the market is. I think I also like to really hear when founders share who they believe their competitors are. What could go wrong?
Yeah.
Tell me all the stuff that could go wrong.
Yeah.
Because that helps me understand if I'm the right partner for you, if I can help you overcome the things that go wrong, and I see you have a clear understanding of your market, your customer, your competitors. That's a fantastic place to start as well. They're the kinds of things, but you'll be surprised how many people come to the table and don't have a clear understanding of that revenue piece, how it correlates with their valuation or what they believe they're valued at, how they're going to spend that money, and that scalable commercialization model, and what could go wrong.
Yeah. Sadly, I'm not surprised.
Yeah. But we're here to help. Happy to have the chat. She's just not always going to hear what you want.
It's crazy, right? I had somebody approach last week who, was, I've tried to raise, but I can't do it myself because I don't have any savings. I've never worked before, and I've got an idea. So,
just an idea.
Yes. But look, I think this is the kind of issue, right? It's like the reality check that's kind of happening. And say reality check, what's really interesting is just, to me, a great example, right? Like one of the most prudent founders I think I've ever met.
And
so
humble.
Every investor dollar, like his own, got maximum benefit. And extracted every bit of value out of every cent that has gone into that business. And, we were talking and we were like, when did that change? Like, when did that actually change and the game changed? And the reality is the game didn't change. Right. We've just, too much hubris has entered the market. And I think in Australia, particularly the size of the market, that is, it's kind of fatalistic behavior, right?
Yeah. Well, I think as well is just because of the international kind of market in the US, Australian founders and startups have always had to punch well above their weight anyway, right? Yeah. They've always had to do more with a lot less. This time is no different. And so, the right founders, you can see them making those hard decisions quickly with empathy and care. It's not the first time that we've had to do, these types of things because of where we sit in that global landscape and our global counterparts. And I think the other, encouraging thing that I talk to the startups about when I speak to them is, if there are international competitors in this market, like we've seen a lot in fintech, particularly with open data, you see a lot of people out of the market. If you can almost be the Stephen Bradbury, of your vertical. If you spend, get tight, spend less, do more with less, stay agile, create a great customer experience, don't lose your head or lose sight of who you are. By default, you will acquire customers because other companies are pulling out of this market or are shutting down, and those who spent more based on their future growth rate as opposed to what they should have been spending. And so we will see a lot of consolidation, and not just in the fintech market, and we'll actually see clients, moving home. Yeah. And that's a huge opportunity for Australian startups.
I've always said to my kids, your dad's not where he is because of talent. I just outlast everybody else.
Just a Stephen Bradbury.
Stephen Bradbury. And I'm really happy with that tag. Right. Yeah. And I think, it's a really good point that you make. Also, I wanted to ask you, because you do see a lot of trends, and we've talked a lot about some of the redundancies that have happened. And whilst it's always an unfortunate experience, sometimes what it does is it gives somebody the catalyst to go, hey, I'm going to go and I'm going to chase that dream now. Probably not a bad time to be doing that. What are some of the trends that you're seeing that if you were to do it, you'd go, right, that's the problem I'm going to pick?
Yeah. It's funny because I'm seeing different trends, like trends at a micro level and at a macro level. So I'll give you an example. With all of the redundancies, I would not be exaggerating if I said of my ex-colleagues and friends and things that have been made redundant, 80% of them have probably decided to go and do something on their own or to become a consultant or contractor for what they do for a role. And I think COVID has taught us that you can have that kind of freedom, the remote pieces there. I think people are getting more concerned because of the changes in the market around diversifying their income.
Yeah.
And what I'm finding is startups, because of how lean the industry has become, and just tech in generally, instead of paying someone for a full-time role, they're looking for people for 2-3 days a week to fill a gap. And they know that they're capable of doing that work. And so I'm seeing a huge trend in that.
Yeah.
And I did, a little bit of contracting stuff and whatever over Christmas before I started with Scalare. And I can tell you, and you probably know this better than me, it's the first time I've never had just one full-time job.
Yeah.
And managing my inboxes and managing my invoices and just staying on top of stuff was just an absolute nightmare. So if you think about the gig economy and you think about this big shift to consulting, a couple of days here, a few hours there, whatever, there's got to be some innovation in that for actually managing the back end of that and managing yourself. And so that's one area that's really interesting to me. The other is I still think that we started to scratch the surface around open data and the payment piece. And because of, slow to launch products in the market and things, I think a lot of people have abandoned ship or they've had to pivot and focus on other areas. But I feel like that'll come back with a vengeance. I feel like it's having a bit of a lull at the moment, but there's still huge opportunities. And I can see a lot of trends in the market around the shift from, and again, I think this is COVID driven and a sign of the market that we're in, but the cost of retaining a customer and the focus on that versus the cost of acquiring a customer. Yeah. So I've seen some really fantastic tech pitches in the last few weeks where they're helping industry verticals like a bank, for example, better retain a customer and stop them kind of shopping around rather than having them leave. And so that focus on consumer experience and retention, I think, has been heightened.
Yeah.
And again, it might feed back to that Stephen Bradbury piece. If you can retain your customers, create a good experience and pick up new customers on the way by being the last woman or man standing, then that's the way to win at the moment.
Yeah, absolutely. Now we're going to finish on a bit of positive news. So our friends at Revolut announced a profit.
Yes.
And finally, right, we show that neobanks can be profitable, although they're not technically a bank. What did you make of that?
I thought that was really exciting because, over the last few years, going from Braintree to go cardless, which were UK-based, and kind of watching Revolut from a distance and then seeing their expansion, with what happened in the market and particularly in that, I know they're not a bank, but the neobank space, I was concerned for them. because they did accelerate their growth so quickly. But they also do a fantastic job and have great customer experience.
Yeah.
So I was expecting them to kind of lean back and kind of maybe pull back to a tighter market, but they have just done an amazing job. And it's an example of, I bet, I probably haven't looked into it enough, but I bet if we sat down and looked at the decisions they've made over the last 2 years, there'll be clear signs that they were on a path to profitability. Yeah. And that's another thing that investors are looking for at the moment. It's that path to profitability. And going back to the till raise, which is as equally good news, you know, I'm sure that when they were having those conversations, there's a path to profitability. Yeah. And that's what Revolut's delivered. So it's fantastic. And congrats to anybody who was invested there, and hold on for the ride.
Fantastic. Well, Carolyn, it's been great to see you again. Thanks for joining me. Where can people find out more about Scalari?
Yeah, so on our website, scalaripartners.com, and feel free just to hit me up on LinkedIn as always. Always happy for a chat. I drink coffee and Pinot Noir.
Awesome. And as always, you can connect with me on LinkedIn and Twitter. Thanks for joining us. If you're coming back, thanks so much for your support. And if you're new to the show, make sure you give us a follow. And if you're watching us on YouTube, give us a like and subscribe. Until the next show, keep safe. Fintech Chatter is presented by Tier 1 People, leaders in fintech executive search. We'll help you find world-class fintech leadership talent to build world-class fintech ventures. And you can find out more at tier1people.com.